Hello, this is Jed Brewer with Study Groups in the Below the Line Club. Nice to be able to talk with you today on this in Western Washington where I'm at. It's a beautiful blue sky out. I know it's varied across the country, but we're enjoying a Chamber of Commerce day here. Two topics that we're going to discuss are some of these government pandemic programs. The Paycheck Protection Program, it had a round one, and now we've had a round two. I know many people on the call have applied for either round one or round two. Some have already received forgiveness, but we'll go into that in detail and also talk about a lesser known employee retention credit that has some fairly sizable dollars in it that some of our firms or many of our firms may apply for and be able to qualify for. There were some sizable changes between 2020 when the employee retention credit was first introduced and 2021. And so real pleased that Ben Klassen, who is an attorney at Winthrop and Weinstine. So Ben is an expert in these areas and will offer us some insight. We want this to be very educational. So want you to be able to ask any questions you have. Please type those questions into the GoToWebinar dialog box, and I'll relay those to Ben as we move through the presentation. Ben, just a little bit about him. He talked with us, this was over a year ago or about a year ago when the PPP round one first came out and did a superb job of helping educate all of our members on the PPP that most people were able to apply for and receive forgiveness on. So really glad, Ben, that you're able to come back with us and share again. Just background on Ben. He's, as I said, an attorney at Winthrop and Weinstine out of Minneapolis area. He works in M&A and business finance, and really his specialty is in supporting franchisees and businesses in the energy generating, transmitting, and retailing industries. So working specifically in the industries that we all work in. And a little bit about his firm. Winthrop is a full-line law firm based out of Minneapolis. As I mentioned, they have experience in representing multi-unit franchisees and other businesses in our industry and other spaces. You may be familiar with Jim Durkin or Tammy, who both work there. Tammy Bean, she's president of Winthrop and used to work exclusively in this space, but now running the whole organization. And then Jim Durkin, who really heads Winthrop and the space that we operate in. So, Ben, thank you so much for your time here on the call. And without further ado, I'm going to turn the floor over to you so you can start talking about the Paycheck Protection Program, round two, as well as the employee retention credit.
Well, thanks so much, Jed, and really happy to join the group again to talk through these programs. It's interesting having spoken last year in the early days of the PPP, and really have seen a lot of clients and other businesses that we've spoken with have become extremely familiar with the terms of the program. And it's when working with banks and accountants on both the PPP, and then many of you may be familiar with the employee retention credit as well. So we'll get into some of the details and kind of the less on the general side, more specific questions on the PPP if you're interested in applying for the second draw. And then also looking a little bit more high level in the employee retention credit, because similarly to the PPP, almost every major piece of legislation that's come out of Congress over the last year has substantially changed the program. So if you're doing research online or speaking with people, getting the right information is, you also need to look at kind of the date that the information was published, and in some cases the agencies haven't yet got up to speed and issued guidance that give us answers on some of the questions. But at this point, at least on the PPP, we should have some more detail. So looking at the overview on the two topics that we're going to talk about today, on the PPP side for the second draw, we'll talk about the specific criteria for your businesses to qualify. There's the revenue tests or the gross receipts, and also the certifications that you made on the loan application, which you might have been familiar with in the first draw, and how those certifications might apply now that the economic climate is a little bit different in 2021. We'll also talk about the employee retention credit there's been a lot of confusing and changing information on the application of the credit, and the information has changed over time, but the credit also operates differently if you're looking at calendar year 2020, where you may be potentially able to go back and claim the credit now that it's been made available for borrowers who participate in the PPP to also obtain the ERC, and then also the different rules that apply in 2021. So we'll try to give some kind of summary information and help organize the ideas between the different years of the credits to help you identify whether you might pursue them. We'll start on the criteria, the high level for the second draw, the PPP. So the biggest difference between the programs for the first draw and the second draw would be the gross receipts test, where borrowers would have had to experience a 25% reduction on a calendar quarter basis in 2020 compared to 2019. And the intent of the change was to only provide this loan to borrowers who were significantly impacted by by COVID or other disruptions that occurred to the economy in 2020. Unfortunately, gross receipts isn't a perfect measure, and so we've spoken with a number of people who have might have had a reduction in revenue, but not at 25%, or otherwise their profits and I think everyone's costs have gone up in one way or another. But unfortunately, just for the purposes of this program, the 25% test applies just to the gross receipts. The second major factor that we want to continue to highlight is the certification and good faith that the current economic uncertainty makes the loan request necessary to support your ongoing operations. And how do we evaluate that criteria? And we can take the guidance that the SBA has issued and evaluate it for the current economic situation. And we can talk a little bit about how to document that as well. The overall criteria, the maximum loan amount has been, or the maximum employee count has been reduced from 500 employees to 300 employees on a full-time equivalent basis. There's been a couple other changes not highlighted here. Public companies are now excluded. There was an alternative size standard that's been eliminated for the draw two that would have made some other borrowers that perhaps even had more than 500 employees eligible. And then there is there's almost a increase in eligibility for restaurants and other businesses in the accommodations industry. And we won't go into detail on those, but if anyone has any specific questions, we can address those as well. The other component is...
Then, quick question. So PPP1, you needed under 500 employees. PPP2, you need under 300 employees. So a changing definition there. One person said, our company and affiliates have over 500 employees. However, we qualify for PPP1 because of the definition of small business. I'm not sure what that nuance is, but can we qualify for PPP2? So in their case, they have over 500 employees between company and affiliates, but somehow we're able to qualify for PPP1 due to the definition of small business.
Yeah, the definitions were changed for the second draw. So my understanding is that you would no longer be able to use the alternative size standard, and that it's more of a hard cap on the second draw. But that's something that'd be worth reviewing the specific language to confirm.
So PPP1 you had 500 employees, although there was an alternative size definition. PPP2, it's 300 employees, but that alternative size definition no longer applies.
That's right.
Okay.
Yeah, there were some lesser known ways to qualify for the first draw PPP, where there were industry specific employee limits, and then there were also a size standard that was based on revenue, which in some circumstances could allow a borrower to qualify, and some of those additional avenues were closed out. The second round of the program is more intended to what traditionally would be considered small business. The first draw was, I think really it was intended to be a broad economic support, across all industries that would really help prevent kind of the systemic issues that were a concern in March of April last year, where we really did have a great amount of uncertainty. Unfortunately, I think the program was kind of came in under some backlash because the public was sort of informed that this would be for small businesses, and it was kind of communicated as if it were just solely mom or pop shops or only a few employees. Where if you read the rules, it certainly was available to support large employers. So we're seeing that now a little bit with with borrowers who had loans above $2 million and some of the obstacles that have been put in place to go through the forgiveness process. But hopefully we'll be able to clear those up a little bit. The second draw is certainly a more limited program and won't have quite as many of the eligible participants from the first draw.
And Ben, real quickly before we move on to defining gross receipts more, on point 3 of your last slide, you had said including affiliates on this 300 full-time equivalent employees. And of note, it's full-time equivalent employees, 300, because a lot of our people use part-time workers. But can you give definition on affiliates and how that works in?
Sure. So the affiliates has a fairly broad definition under the SBA rules, and unfortunately, it has a definition that includes it's a facts and circumstances test that could allow the SBA some discretion, given how important the program was and valuable what in effect would turn into a grant if the loan is forgiven. It was valuable to many businesses. Ideally you'd have a little bit more certainty on where affiliation would exist. But generally, if a company has joint ownership, or if two companies have joint ownership with somebody with 50% or more ownership in another business, then those companies would be affiliates. It's actually possible to have affiliation if there's less than a majority control. There's something called negative control, which would be the ability to block the borrower from taking certain actions. So you kind of consider those minority shareholder rights. There's actually what quasi case law that interprets this in the administrative hearings and usually in the government contracting context. But there's certain types of negative controls that could be considered like the ordinary minority owner protections that wouldn't create affiliation, and yet there's other blocking rights that would create an affiliation. So it's unfortunately the answer is a little bit complicated, but as a general matter, if you have a majority owner, would create an affiliation relationship. And then once you have affiliation, if there's common ownership, you could create an entire broad group that would create where all entities in the group would be affiliates with each other, and you would have to aggregate the number of employees across the entire network.
That makes sense. Yeah, it gets kind of complicated as you pull these affiliates together. Just big picture question before we dive into too much detail. PPP2, there's still funds left, right? If we were to apply, they have not yet been exhausted.
Yeah, on the first draw, or on the second draw.
The second draw.
Yeah, there still are funds available. We only have a limited time. I believe it's May 31st to submit an application.
Okay.
But it hasn't quite gone as quickly as the first draw had.
All right, I'll let you continue on. Thanks for clarifying that, Ben.
Absolutely. So we can talk about gross receipts a little bit. So this isn't a profit measure at all. Gross receipts would be the gross revenue of the business, and generally look at it on a tax basis. If you follow cash accounting rules for tax purposes, then your gross receipts would be calculated on a cash basis, and then on the same, if you're using accrual accounting, you would use accrued revenue. The overall gross receipts wouldn't really be net of any other items except returns or and also taxes are going to be excluded. But if you receive revenue and the majority of the cost is going to be passed along to independent contractors or to other vendors, that's the total amount of the revenue would still be included for the purposes of this calculation. So you may be able to use your tax filings to provide a good calculation of the amount. But we noted that sales taxes and other taxes collected from customers are going to be excluded. Affiliated transactions, I think you could see, if there's intercompany rent payments or other or other intercompany costs among affiliates would not count for the gross receipts. Capital contributions and capital gains are excluded, sort of the long-term items and not the short-term revenues. And then the PPP loans and EIDL advances would also be excluded. There's a couple other minor exceptions, I think, at the bottom there, mentioning freight forwarder or customs brokers, where if the funds are received on behalf of another party, they may not be included in gross revenues. So there's kind of an accounting technicality with the gross receipts calculation. And then as far as calculating a 25% reduction, for the most part, you can compare fiscal quarters with a comparable quarter between 2020 and 2019. If it's easy enough where you could show a 25% decrease over the course of the entire year, you could simply provide your tax filings that would demonstrate that. It may be easier in those cases. And there are special rules that would allow businesses who were in business for less than the entirety of 2019 to provide a comparison using different quarters. So, the standard comparison would be, Q2 versus Q2, for example, in 2020 against 2019. But if your business started in mid-year 2019, you could compare any quarter in 2020 with Q3 or Q4 in 2019. Similarly, if you were only in operation for Q4 in 2019, you could make that comparison for any quarter in 2020 against Q4 2019. And then finally, if your business were a new business in 2020, then there's the possibility to compare against Q1 2020 actually for purposes of satisfying this 25% reduction test. There's now some helpful guidance in how to document the reduction. We mentioned you can provide quarterly financial statements, you can use tax statements, you can also provide bank statements, and the program should be, it's supposed to be available to borrowers without necessarily as sophisticated financial reporting. There's no requirement that you have audited or reviewed financials. You could also provide bank statements or other documentation from your internal systems, and possibly even by marking it up or annotating to exclude capital contributions or other items that wouldn't satisfy the definition of gross receipts. So the application process is supposed to be relatively streamlined and efficient at this point. There's maybe the second draw program is not quite as broad the number of borrowers participating. However, it's designed to be a simpler application process and should be less burdensome for borrowers, particularly on the smaller end. If for borrowers with loans that would be below $150,000, there's supposed to be a one-page application that would be submitted to show your eligibility. And as long as the documentation is along, it should flow through relatively easily. So moving on from the new 25% requirements, we'll kind of look back at the loan necessity certification that would have been made in the first draw of the PPP as well. The certification is to be made in good faith at the time of the application. There's a little bit of flexibility with the good faith standard, although it's a little bit problematic, and I've had plenty of conversations with applicants who are, the person who actually has to sign the application, and asking somebody to make a statement in good faith is a really difficult standard because the word necessary included in the certification you're making is a challenging thing, is a challenging one to make, because what is truly necessary? If the business could significantly reduce headcount, for example, or otherwise, reduce the size of its operations, or somehow shut something down and still remain in business, is the loan necessary? We always took the view that the purpose of the program should be read into the application and the loan requirements. The program was designed to maintain 100% employment, and your application and your certification of the loan being necessary should be interpreted where you've been able to keep every single job that's currently on your payroll. So the standard, the word necessary, I think, should be qualified by some of the other terms in the certification itself, and then also the spirit of the program. After many borrowers had applied for the loan already, on May 13th, 2020, and I flagged that date because for borrowers who might still not have had their loan forgiven on the first draw PPP, it's debatable whether these additional characteristics should even apply, or these additional factors should apply to the determination of whether your loan certification was made in good faith. And if push came to shove and there were ever an issue on contesting the eligibility for the program, it's arguable that the guidance came out too late. And the SBA has itself acknowledged that a borrower can rely on the guidance that was in effect at the time the application was made. So these changes coming in after people had already signed something in good faith and applied should be construed, and you might still conduct an analysis to provide support for what you've submitted, but from a legal standpoint, you can rely on just what was available at the time of your application. There's two factors that were given, and this was provided in an FAQ on the SBA's website. I note that this isn't a legal test, so this isn't a two-prong test where you have to satisfy both prongs and therefore you satisfy. We view them more as they're factors to be considered, and if you're concerned about being able to demonstrate your eligibility for the program and whether this is looking back on the first draw or in the second draw, providing some kind of write-up or analysis that applies these two factors and in the particulars of your business to determine how they apply and to show support for your eligibility for the loan. The first factor in your current business activity, looking back at the time of the application, first, what is your business? Looking at the industry and the business activities, and then also how have you been impacted by COVID or disruptions to supply chains, or the employee shortages or whatever other impacts that you've experienced over the last year. And then the second factor is the availability of other sources of liquidity that'd be sufficient to support your ongoing operations in a manner that's not significantly detrimental to the business. And other sources of liquidity we've generally interpreted to mean other loans available. We haven't been given any indication that other sources of liquidity should require a principal of the business to, add additional funds or potentially to seek outside investment to contribute capital to the company. In a way that contributing your own funds may be significantly detrimental because, there may be less funds that you'd have available to support the company on an ongoing basis. So things that, and if you're familiar, for borrowers who've had loans that are above $2 million, if you've seen the 3509 questionnaire, there are some hints at what the SBA might be looking at. The fact that there might be other loans that you have outstanding with credit available to be drawn would be a material factor that you could consider. If you're providing support and doing some kind of write-up or management report to have in your files and potentially provide if the SBA requests additional documentation, I think to highlight, whether you do have outside loans or whether you have unencumbered assets that could be used as collateral to obtain additional financing would be important factors to provide. But really, everything that's happened in the last year and the impacts to the economy and the ongoing uncertainty are sufficient enough where your business. When I've ended up talking with people, they've come up with plenty of factors to cite, and the more specific, I think, the better of the impacts. And so we've generally, to provide the documentation in case there actually were some type of audit or further review on the SBA side where they've asked you to provide documentation. We've done what we call impact statements to provide the write-up where you can have management look at the specific financial information that's available at the time, apply these two factors, and then conduct an analysis. And often there's sort of almost an undue burden on the one individual who has to sign the application. So from a matter of corporate governance, it could be a best practice to have the board of directors or board of managers, or if there's a similar governing body that could sign off on an impact statement provided by management to provide appropriate documentation in your file. And particularly for loans above $2 million, we have seen that there's been after borrowers have submitted an application for forgiveness, the SBA will come back and perhaps ask for additional documentation. It's still a little bit uncertain whether these requests for documentation will result in formal challenges to eligibility, or if they're going to try to use 2020 vision and look back and say that perhaps you ended up having a good year in 2020 and you may not be and it may not look like that the loan might have been truly necessary at the time. The loan certification has to date back to the time of the application. And even if the SBA is asking questions about the results after the fact, it's really a hindsight bias to say, to look back now and say that the economy did relatively well in certain areas, and obviously plenty of industries suffered a lot. But when we looked at how things could have been in March and April of last year, I mean, it was a very scary time, and business owners had to make a lot of difficult decisions, and many people kept employees on, particularly because of this program. So when these are all things that can be used in support of your own application, then also just thinking back of what good faith means to you, and how you can continue to push for forgiveness that you may be entitled to.
It's interesting, Ben. You mentioned at time of application being important, and also the principal goals of the program, which were to maintain employee headcount. And we think back to May 13th or April or whenever people applied for the first go around, and in our industry, for many folks, volumes were off 40%. It was kind of clear that there was tons of uncertainty and people were making drastic cuts to their businesses. Turns out that whether it be due to luck or God's providence or industry dynamics, whatever you want to attribute it to, margins ended up being very good. So profits were okay for most people, not all, but most. But now, we're thinking about round two. We're just coming off of a good profit year, but it's time of application for round two, and many of us, our volumes are still off, maybe 5 to 10%, and who knows what margins will look like going forward. And if our volumes are off, do we need as many people in our organization as we once had? And I know this is a critical question that people are trying to, wrestle with. Can I find other sources of liquidity? I'm not going to go bankrupt. I'll figure it out somehow. But I may do it with less people on my team as needed. So anyway, I don't have the answers, but I appreciate your insight and for any recommendations that you have for people in our businesses. That we're coming off a strong profitability year, but the volumes are down at this point in time. Should we apply round two or not?
Yeah, those are great factors to be looking at. I'd say if you had a profitable 2020, one direct impact that may lean towards not being able to make the loan necessity certification is that if you're sitting on a bunch of retained earnings, you may have other sources of liquidity. However, at the same token, I think you're mentioning how if you'd like to maintain employment at 100% of previous levels, that that may be a decision that you wouldn't have otherwise made, and it may not be necessary to have that full headcount in the interim period. When you actually look at the certification that you're asked to make, I think it's important to note it's the economic uncertainty and not necessarily the full economic impact that is what makes the loan necessary. And commodity costs are one thing that have been all over the place in a lot of industries, and if that could create additional impacts, and even if margins might have been better for a certain time period, there's an expectation that you may have negative impacts going forward. And I do like providing specifics to the analysis that you have. I mean, if you're submitting this application, you're not wholly sure. I think doing some type of projection and doing some type of means testing and saying, well, if we have this type of increase to our commodity costs or other expenses, or this potential impact to our revenues, what does that look like given our current retained earnings, or whatever cash or loan loans that you may have available and how long you could continue in operations if things were, are impacted the way that they may be. So then having that information in the file, could have the multiple benefits of giving yourself peace of mind, but then also, again, if when the SBA has asked for additional information, it's always good to be able to give them something that you can show as of this date. These are literally what we looked at. This is I didn't take this lightly and just go through the program. I looked at it carefully and evaluated it with my circumstances.
Yeah, documenting, that's a good point. Well, if anybody has other questions as it relates to this, please ask them, and we'll circle back and catch them at the end. But I do want to talk about the employee retention credit too. So I'll let you wrap up with any comments on the PPP2, and then we'll turn to that employee retention credit then.
Well, overall, I think the PPP has been a very successful program. It's come under some criticism, and I know it's been a challenge for a number of borrowers, but I have encouraged clients that I've spoken to continue to sort of fight for your rights to the program. I mean, that when the rules change and you're getting information that makes it seem like should you have applied initially, or trying to rely, especially looking back in the first round and doing your best on the second round, I do think it was an important program, and the benefit of keeping people on payroll, particularly when the unemployment rolls have been extremely burdened. So keeping people in jobs is certainly a good benefit, and that should be a piece of what you're looking at as applying, and I think support your ability to fight for forgiveness. So I'll move on. Maybe we'll have some time to discuss some questions on the PPP, but we'll talk a little bit about the employee retention credit. I'd say the shift of the request for advice and evaluation that we've done as a law firm has moved more from the PPP to the employee retention credit, especially when at the end of the year the credit was made available to borrowers who had participated with the PPP. Initially, the choice was either or, and most borrowers went with the PPP rather than the employee retention credit. Now that it's been made available, people are looking at whether the credit makes sense in 2021, but then also potentially reevaluating periods in 2020 to see if you might be able to retroactively obtain the credit. The kind of big picture questions to look at, and I think try to organize some of the information, because there's been so many changes and the credit is different over time and for different borrowers that just trying to put things in buckets can to help evaluate. The first thing is just considering the timing of the credit in the year. The 2020 credit is different than the 2021. There's different amounts of the credit. The application is different. The number of employee counts and how large employers may be affected would be different as well. And then the other big issue is how many employees that a borrower or that an employer had in 2019 for purposes of determining whether the employer is a large employer or a smaller employer. Large employers are allowed to participate in the program, but the credit is more limited, and the test is different for 2020 and 2021. So the 2020 credit, which applies to businesses that were impacted during the year 2020, the test is 100 employees to determine, or 100 employees, but the number of employees actually looks back to calendar year 2019. And then for the 2021 credit, the standard is 500 employees, but it again looks back to the number of employees in 2019. So we'll look at some kind of the big picture eligibility. So there's two primary ways, and this is true for the 2020 credit or the 2021 credit. There's two primary.
Quick question on that, Ben. 2019 employees. That's the count of employees, not necessarily the same people. Is that correct?
That's correct. It's a number of employees. I think I've got something on this later, but it's different than the PPP. The employees are any workers who had an average of 30 hours a week during any calendar month in 2019, or 130 hours worked in a month during 2019. Got
it. So I don't have to keep the Sally Joe on, just do I have that position?
Yeah, that's correct. You're just coming up with a total count of employees from 2019 based on that test, and then once you identify the number of 2019 employees for the purposes of the ERC, then you can determine whether you're a small employer or a large employer for purposes of the 2020 or 2021 credit. So there's two ways that a business can be eligible for the ERC. The first is business operations were fully or partially suspended due to orders from governmental authorities related to COVID-19. Now, the governmental order, and I believe in every state there was some type of orders that would have affected either essential businesses or non-essential, and maybe excluding essential businesses. The non-essential businesses were either ordered to close or to partially suspend operations. The order will make a employer eligible if the employer is directly affected by the order. One example we've seen, just there's reduced traffic on the roads, and that's affected businesses in a lot of industries. So the consequential effect of a governmental order reducing demand for your business wouldn't be a qualifying factor for the ERC. If your business was considered non-essential and was ordered to close for a period of time, then your business is eligible for the entire quarter during which a shutdown happened. So the examples given and this program is administered by the IRS and not the SBA, but the examples the IRS gives are if there were a shutdown of the business for 3 weeks or 4 weeks during a fiscal quarter, you're eligible for the entire quarter where that shutdown occurred. They don't give an example of if your shutdown only happened for a few days of time, but presumably any shutdown that would result in a full or partial suspension of your operations would make the business eligible for the full quarter. There's also a revenue test, and the revenue determination is similar to what we talked about for gross receipts on the PPP's perspective. But if revenues were less than 50% of the comparable quarter in 2019 for purposes of the 2020 credit, then you'd be eligible for that entire quarter and for the subsequent quarter. And the revenue test for 2021 is 80%. Again, looking back to 2019, if your revenues were down by more than 20% during a fiscal quarter in 2021 against the comparable quarter in 2019, then you're eligible to take the credit for that quarter. When I say this program looks at calendar quarters for determination of eligibility. If your revenues are down during a quarter, for example, let's look at the first quarter of 2021. If your revenues were down by 25% during Q1, you're eligible for the credit during Q1 and also for Q2. You're able to take the credit for any quarter occurring after a quarter in which you met the revenue test. And that would continue on until you reach a quarter where you no longer satisfied the revenue test because you had revenues that were above 80% of the 2019 amounts.
But I also noted that 2021 change has been, I think, fairly significant for us because many of us wouldn't qualify for a 50% reduction, which was required in 2020, but to only be revenues down 20% in 2021, that brings a lot of us into qualification for this program.
Yeah, it's certainly 50% is a high threshold for businesses to have been impacted, and I think the recognition is that there's still an ongoing effect in a lot of industries, and so a 20% reduction in revenue is pretty significant. And similarly to the PPP, this is tied to employment. So if it's helping support businesses that keep people on payrolls, and providing an incentive to companies is the general target for the ERC as well.
And one question that came in on your first bullet point up there, which is partially or fully suspended due to government orders. I'm curious what partially suspended means. And then the question is, can essential businesses qualify under affected business due to government action?
So a good example of a partial suspension would be a restaurant that only was eligible to provide takeout and could not have could not have customers that came into the restaurant. But if a business had an exemption and was an essential business that was allowed to operate, but determined that they would decline to operate anyway, then that business would not be eligible. Essentially, the government order would have to directly impact your company and prevent you from operating in some manner.
Got it. And if a portion of your business, like say I operate restaurants and I had to go to takeout, but I also had other businesses too, does my whole company qualify? Or if, part of my company was partially shut down?
This is very good question. It kind of is a broad point that may apply across a number of the programs that are rolled out here. And that's the business. When we're talking about a business, and a lot of times, you may have different businesses that are in the same entity. Particularly for the IRS, they evaluate there are, I guess, aggregation rules for this as well. But generally, the employer is based on a single EIN. And having multiple entities that are providing related services, you may have those entities be independently eligible. The limits that we describe in the employee counts, again, they do have an aggregation standard, which is different than the affiliation test under the PPP. For purposes of the ERC, the aggregation rules are a control group, which does more directly look at the 50% equity ownership and having common ownership between different companies, or 80% voting interest, and rather than some of the negative controls or some of the other standards that applied for the PPP.
Okay, so there's a couple ways I think some of our businesses may be able to qualify. One is partially suspending operations, and then also potentially on the revenue test as well. But it's interesting that it's an either or.
Well, I do say or. I mean, there's two ways, I guess. Because it's not an and test where you had to achieve both. I mean, if you had both of the qualifications in any fiscal quarter, that could count. And really, I think your business can be eligible one quarter and then not eligible in another, and then you could become eligible, to follow. So you can bounce back and forth out of the program. But there's some flexibility in your ability to go back and obtain the credit by filing amended Form 941s. We have a little bit of information on that to follow about how to actually obtain the credit itself. But one thing you did mention, I think the kind of downsides of using the EIN as a limitation. I mean, if you have multiple businesses that are under a single EIN, it's possible that you have one business that's significantly impacted and would otherwise be eligible for the credit. I mean, however, if that's offset by gains in another area, you may find that the company is not eligible. So as a general matter, I think, for some of these government programs, it's interesting because it's almost like it adds an incentive to continue to use different entities for different business lines, to the extent that if there's future incentive programs that emerge that may be tied to a specific EIN.
That is an interesting implication. Yeah, we're going forward thinking about.
I always hope that, we learn a little bit from how difficult it was to roll out these programs, and maybe we had things that were in place and maybe not funded, so that if there is another crisis that money would need to be input, that we had a way to do it without having to make up the rules on the fly. We'll see, though, how Congress ultimately decides in their wisdom to address the issue in the future. So we'll go quick through on the amount of the credit. So the 2020 credit was it's 50% credit on up to $10,000 of wages per employee for the entire year. So the maximum credit for 2020 for any employee is $5,000. And then in 2021, it was increased in two different ways. First, the credit was increased to 70% of up to $10,000 of wages per employee, and then it was also made on a per quarter basis. So I mentioned it's the limit is $7,000 per employee for each quarter, or $28,000 credit per employee over the course of the year, assuming the business were eligible for all 4 quarters in 2021. And the credit has been extended through the end of 2021 by the most recent stimulus bill. So the credit is taken against qualified wages. So the qualified wages are generally the overall compensation that are paid to employees, and some of the couple of specific items that Medicare withholdings may be included, and health insurance contributions to the extent excluded from the employee's gross income. And that's for purposes of determining the actual wages paid to the employee. We've got above where we mentioned there's a limit of $10,000 per employee. You would need to have sufficient qualified wages to satisfy that standard.
So quick question on that. Let's say I qualified in first quarter because by the revenue test. So I get $7,000 per employee due to this credit for first quarter, but then I get an additional $7,000 for the second quarter too. Is that what I'm hearing?
That's right. If you're qualifying on the revenue test, the business suspension test doesn't carry over to the next quarter in the same way as the revenue test.
Yeah, so $14,000 per employee. I mean, that can be a very sizable program here for firms.
Correct, and to reduce your withholding obligations, and potentially there's even advances that can make this program more of it look like a grant or an advance credit. So looking at some of the distinctions between the small employer and the large employer standards, we talked a little bit about the way that this is calculated before, and some of the information is included in the bullet on the bottom. But for small employers, you may include all qualified wages for the quarter in which you qualify. So if you qualify in quarter 1, 2021, you can use as much that was of the qualified wages that were paid to that employee up to $10,000. And then for large employers, the credit is available only for periods in which the employee is not providing services. So this is essentially a worker is paid to stay at home. And this happened a little bit more frequently. We saw it, and really when the first round of the PPP came out, I think there were plenty of businesses that, for purposes of the PPP, kept workers on payrolls, even if they weren't allowed to work or weren't able to work at the time. Which does create a little bit of a problem. We can talk about the PPP and the ERC are now both jointly available to employers, but you can't use the same wages that you used to obtain forgiveness on your PPP loan for the ERC. So that's limited a bit some employers' ability to obtain this credit. One thing I have seen is that employees that were perhaps furloughed, but if the employer continued to pay their medical insurance costs, that you may be able to go back and obtain a credit for those medical expenses. It'd be something to evaluate.
So I know the necessity test or whatever with the PPP2 was something that gave people pause even if they qualified on the gross sales. Is there a necessity test with the employee retention credit, or is it just purely a gross sales or if we were partially shut down test?
Yeah, it's really based on whether your business was impacted by a reduction in revenue or by the governmental order. So, one way I've looked at it, when the government is they're trying to act, or governors in various states are trying to act and protect public health, and so they had governmental mandated shutdowns. I mean, in some perspectives, you can look at that as a governmental taking, and the government should be providing compensation for it. So this program is intended to provide some incentive to employers who are so directly affected by some of those governmental shutdowns.
Good, thanks. Yeah, look forward to getting the nuts and bolts here about how this thing works, or how we claim it.
Yeah, so they've actually streamlined this one pretty well. It's interesting seeing how the program is applied by the IRS versus the SBA on the PPP, but you should have a line on your Form 941 when you report your quarterly payroll expenses that allows you to directly claim the credit, report the credit that you are claiming for that quarter. And if sure that you're eligible, if you determine that you're eligible for the credit, you can start by just withholding the amount of the credit from your payroll withholding obligations, and then submit that via the Form 941 to the IRS for reporting purposes. And then if you determine that you were eligible to obtain the credit for 2020, for example, but didn't claim the credit at the time because perhaps you had a PPP loan or for some other factor, you can go back and file a Form 941X to amend your prior filing to take advantage of the credit. And then there's also a credit available as an advance, and the IRS has a specific Form 7200 to apply to obtain advance funding in connection with the program.
Ben, can you go back just a few slides to where the dollars were, like the $7,000 per person? Yeah. So, a question here. I just want to make sure I'm understanding it, but the 2020 credit is available for all 4 quarters of 2020 if you meet the 50% reduction or the partial shutdown. The 2021 credit is so far only available for the first 2 quarters of 2021. Is that right?
The 2021 credit is now available for all 4 quarters of 2021. It was extended twice. It was extended for the first 2 quarters in the budget bill at the end of 2020, but then in the latest Relief Act, it was extended through year-end 2021. I cannot remember if the credit is available for Q1 2020. It may be because some of the impact occurred during March. So the way the rules were written, you might have had an impact or a shutdown during the very, very end of Q1, but you may still be eligible to the credit. But I would need to double check that.
So if I'm hearing you right, in 2021, it's available all 4 quarters now, and that's been a recent change. So it's $7,000 per employee for each quarter. So that's $28,000 for the whole year if I qualify per employee. Is that correct?
Correct.
That's a lot of dollars. Yeah. Okay. And then to this partial shutdown thing, one person says we don't meet the revenue test, but in our case, we had a state curfew in 2020 that reduced the hours of our operation, like they couldn't be open at night when they normally would have. Is that a partial shutdown? Does that allow me to qualify for this program?
I hate to punt. I would want to look at the specific examples for that. I believe it does if you have reduced hours of operation, but the IRS is very good. They like providing examples, so they have many hypothetical businesses if you look at the rules, and you may be able to find an example that's directly on point to that question.
Yeah. So possibly, yeah. And with the dollar size of this employee retention credit, I think it's certainly worthy looking more into.
Agreed.
Ben, just going back to a couple of questions. This one has to do with the PPP2 that we were talking about before, and that necessity test, where we got to make that good faith statement. The question that came in, it says, the frequently asked questions seem to indicate that meeting the revenue drop test alone provides a safe harbor for the need of certification. Is that correct?
That's yeah, I believe that is correct. I would want to look back at the FAQs to confirm, but if the FAQs are considered SBA guidance, so if you have a definitive answer on that from the FAQs, that you can rely on that for a safe harbor.
So does that then take the sort of necessity test out of the equation? If I met the revenue drop, regardless of what my profits are, I'm good to go. I haven't read the FAQs fully, but assuming that is correct.
Yeah, that would if the loan necessity certification is deemed made, then it may still be helpful to have some documentation of what you provided, but it's presumptive that you have satisfied So I'd want to look at the exact language of what the FAQ says, but it's certainly something that you can rely on.
Yeah, that sounds worthy. I remember they put together, I don't know, it was like 50 FAQs or something like that, and answers to it. So.
Yeah, I thought I looked at the most recent one. I don't recall seeing that one, but if it's in there, then definitely something to confirm.
Okay, and then well, some other questions come in. I mean, we've talked about PPP2, we've talked about the employee retention credit, but with the new administration, I mean, there's new programs that have rolled out as recently as, the last week or two. One of them I've heard about is the Restaurant Revitalization Fund. Can you just give us a high level of the Restaurant Revitalization Fund and, how people qualify or who that's for? Because I think it may be applicable to some of us.
Sure. The Restaurant Revitalization Fund grant is a grant program that's equal to provides a dollar for dollar grant for the reduction in revenue between 2019 as compared to 2019. Sorry, for 2020 compared to 2019 for any restaurant, bar, bakery, brewery, distillery, really any similar business where the public gathers to consume food or beverages. There was some detail provided on the specific businesses, because I think you mentioned there may be businesses that have restaurants on site or mixed use properties, and the standard is for eligibility would be 33% of your receipts would be for on sale purposes. So on sale is food or beverage that's sold for consumption on the premises. So essentially sit down dining. So if you can establish 33% of your revenue coming from on sale, then you may be eligible, and you have a reduction in revenue, you may be eligible for that fund program as well.
So that may be something for those of us who are selling food to look into. There could be credits or money in there. Are there other government programs for our type of businesses, thinking petroleum, convenience stores, restaurants, that we should be on the lookout to in light of the new legislation that's evolving all the time?
These are the primary. I mean, there are still a lot of local and SBA programs, or maybe EIDL funds that you could evaluate. The latest stimulus bill was a little bit more tailored to specific industries. The restaurant revitalization, but there was also a event space or museums and venue type grant program, and relief for the airline industry and other transportation businesses. So that there are other industry specific programs to evaluate.
Okay, yeah, thank you. And then coming back, Ben, just to a couple other questions, sort of details here. And in the 2021, this is the employee retention credit. The person just says, I assume you're comparing 2021 quarter revenue to the same quarter in 2019. Is that true?
That's correct.
Yeah. And then another question, it just says gas stations have been essential businesses, but several little things have impacted the revenue, but not by 50%. So we can apply under the affected rules by the local ordinances wording. Just trying to make sure I understand this question. I think he's just saying I don't qualify by the revenue, but I may qualify by local ordinances that have caused me damage. So if we get the credit under this assumption and the IRS does not agree later on, what are the consequences?
That you have to repay the amount. I'd have to check back on the specific penalties that could be associated with the withholdings that were made if inappropriately. Sorry, I don't have quite a precise answer on the impact of that one. I think providing the information that you have to the IRS and talking to your accountant to hopefully be able to kind of show that in good faith that you've corrected the error and submitted the funding. Perhaps you could avoid any penalty.
And then lastly, assuming somebody's qualified for PPP1, maybe even PPP2, you said you can do the employee retention credit even if you've done the PPP, but you can't use the same dollars. So how do those two work in parallel with each other?
So there's a definition for qualified wages that are eligible for the employee retention credit. Those wages, you have to be able to add up how much was paid to that employee and come up with up to $10,000 that could be included. Now, if those wages were also qualified payroll costs under the PPP, and you've already applied those costs, then those same wages could not be used as qualified wages under the ERC.
Okay.
And just to go back to an earlier question, sorry, because it was an important one for the loans necessity certification, but I'm looking at the FAQs, and certainly the all second draw loan borrowers who have to show the 25% reduction in revenue, so it will be deemed to have made the required certification for necessity and good faith. So there really doesn't seem to be a risk that a borrower could be second guessed on that certification when submitting the application, which certainly would take the pressure off when applying.
Well, that sounds like a big thing. So really, the FAQs just say I qualify for PPP2 if my revenue is off that sufficient amount.
That's correct.
Okay, so I think that helps a lot of people on that good faith necessity test that are trying to say, do I have access to other sources of capital? Yeah, I could, take out a loan or take out a loan on a loan or call up grandpa or, what have you. People are creative, and when the back is against the wall, the last thing we want to do is go out of business, right? So we find a way. Well,
that's why it's tough to rely on a good faith certification. We don't love that as being used as a standard because it really kind of puts the onus on the individual who's signing the application. So it's unfortunate. You still have to make the certification and sign the application, but the SBA is saying that they won't come back and challenge it anyway. And really, because the loan amounts are capped at $2 million for the second draw, it was also unlikely that there's been much scrutiny on the loan necessity certification for the smaller loans in the first place. It's generally been the larger borrowers that have dealt with kind of second guessing on the certification for those who are above $2 million.
Well, good to know. And Ben, thank you so much for all this information. We're here just a couple minutes past the top of the hour, but this is important stuff. There's lots of dollars in here potentially. And the two can work in tandem with each other. It's not an either or, whether it's the PPP2 or this employee retention credit. And like you said at the end, there's even some other programs like the Restaurant Revitalization Fund that just came out that maybe that's worthy of a future webinar, perhaps, of us all learning more about to see if that may be eligible for our businesses too. So we'll send out the slide deck here that Ben just kindly made available. We'll send out the recording too, so you can share it with a colleague or look at it again. But we'll give you Ben's contact, and I know Ben would invite any additional questions that you have for him, and just really appreciate your time, Ben, and everybody at Winthrop and Weinstine for being such a valuable resource to our members during this time. So thank you, Ben, and wish you all a good day. Bye.
Thank you as well.